So we're doing this live, so there are some technical difficulties. It's been a while that I've been active with this group, and I'm Christopher Waikoko, Chief Marketing Officer of our company. We provide an accounting and wealth planning service solution. Now we're going to talk about the net flow. So it's been actually too low. Okay, 10 to 15 our viewers may experience a low quality screen. Okay. Well, I cannot do anything right now. So we're going to go and discuss. I mean, you've been working a lot, but people don't fail to plan. We just plan to fail. So that's the reason we're talking about the more that you're working and making money, the more that you save as much as you have. And more than saving, the most important thing is tax planning, which a lot of us here in the United States, you will be ending up paying at least more than 30% on taxes. If you made 100,000, so pretty sure you have to pay Uncle some $30,000. But you heard the saying that rich people they actually pay zero or less taxes because there's a strategy that you need to do and apply and able to get there. And that's the reason why I'm going to share my screen and share to you that how to think and act like rich. All right, so on our presentation today, we're going to understand your net flow. So your net flow, it is once after your income, then less your expenses. That is what you call the net flow. So I'll share my screen. Okay, stop sharing. Okay, now I'm gonna share my screen through Canvas. So I have to stop. This is complex. So let me share my screen. Okay, so we're live right now. All right, I have to share the screen. Now just the window, this one, share. Okay, I need to check if it's, okay, there you go. So understanding your net flow. So on this, wait, now I also have to check whether it's being shared here. Mhm. I don't know if it's the screen. I think they're having a hard time. Oh, I think I have to go here. Okay. The internet is not doing anything. Stop sharing screen, and then I have to reshare the screen again. Dang. I can't imagine that this is having a hard time to do the sharing. Hmm. So we're gonna share the screen and then share. If it's sharing it, then that one should show that I'm sharing the screen. Hmm. So we go back here. Uh-huh. The only thing now I cannot see is where's the tab here. Dang. Okay, share. Or maybe it's just slow. Okay, there you go. I found it. All right. So we're going to discuss about understanding your net flow. Um, the typical income the sources that we're getting are from, or where we put our money are stocks, bonds, annuities, real estates, 401k. Those are the asset accumulation strategy. And more than, aside from that, how is the implication of taxes on here? So when your income is from W-2, they are subject to ordinary income tax. That's 32%, or I mean 30%. And then if you put your money to Roth or SEP IRA, uh, they are typically, you already pay the taxes before. And so when you withdraw the money, they're no longer subject to taxes. And then also, when you invest your money to real estate, they are capital gain tax. And the other company like banks and Fortune 500, what they're using is an index strategy through a form of life insurance. So when they're whatever the money that made under their life insurance, it's gonna be tax exempt. So of course, the best choice is bucket number four. And then also with the distribution of money, of all the way you put your money, the best strategy or the highest amount of money that you can also get is through an index or life insurance and overfunded life insurance. So what you prefer is to get more money and almost zero taxes. We're gonna skip over this one. The three biggest risks during retirement. Any type of income that we're planning to do, we want to protect ourselves from inflation, which is the stock market or even the downside of the market. When we are already stopped working, if we retire, we want to make sure that our income is more than enough to cover our expenses when at the age of 60 or 65. And then ultimately, taxes. This usually is 30%, especially if you're on your working career. So, how much more? Basically, if you're working 12 months, the 4 months of your salary go to the IRS. But according to the study, that the making of the difference between the guaranteed income and expenses is maintaining your lifestyle in retirement. Typically, Social Security gives you 2,000, pension is 1,500, but the income gap of monthly expenses, according to recent statistics, is 5,000 per month. So even if you get your social and pension, that's only 3,500, you still a deficit of 1,500. You must fill the gap with money from your retirement in a nest egg. The question, how are you going to fill that retirement? Especially with the inflation rate that eventually they said that they will double the taxes when you retire. So what's your option? Even in a nursing home, the estimated cost to be in the nursing home care without depending to your kids is 113,000. Where are you gonna get that money? Because that long-term care is way more in demand rather the chance of your house getting fire or even a car accident. The deductions, you're not gonna get that no more when you retire. So of all the boxes we discussed, what you want, it's protection from inflation, protection from taxes. So that's why what we're going through over right now, any type of money that you make from a life insurance is you want to use an index universal life. So an IUL, because an IUL, any loans taken are not considered distributions and are thus not subject to income tax. Also, it provides you also a tax deferred growth under Internal Revenue Code Section 7702. Then modified endowment contract means cash value life insurance contract in the United States where the premiums paid have exceeded the amount allowed to keep the full tax treatment of a cash value in a life insurance policy. So any money that you can earn from an index universal, you could when you start and open a policy, it could be a you could use when something happened, the policyholder passed away, there's a death benefit, income replacement. If you have kids for college supplement, you can use that. Even business succession planning, if your company owns debts, this could be a good payment options and other mortgage. And most of all, estate tax coverage. You will be protected. So we discussed the following use of it and what is the product. This is the Index Universal Life that has tax-free death benefit, tax-deferred cash value, tax-free loan, and power of indexing strategy. So the additional information in a 401k rule of thumb, which you put your money at your company matched and considered alternative wealth accounts. The mutual funds rule of thumb have enough assets liquid for 4 to 6 months of income for emergencies rather than being taxed every year on gains considered alternatives that grow tax deferred. So Ray Kroc are the famous people together with Disneyland. They're using this Index Universal as a strategy. And then at the end, let me show you your money, how your index can grow. So this is a typical investment of a 40-year-old guy. He put a money, $1,000 per month. That's 12,000 in a year. In 10 years, it's 120,000. After 20 years, you would see the growth of his money. He has a death benefit of 265,000. But also, if he would like to get the money from his investment for 20 years, he could get up to 337,825. So if you've noticed, if you put your money, your 120,000 in the bank, that's still going to be a 120,000 amount. But compare with the index universal, it already doubled. Now, if there are another option here that which you're going to like, so if your money already doubled, you just pay 120,000. But look what happened, and the age 26 years that you keep your money there. At the age of 66, you have a 47,000 retirement income, and this 47,000 per year, you will receive it for not just 10 years. You will receive it on the next 20 years. So that is almost equivalent to 900,000. Remember, you only invest your money, you only put 120,000. So that's the power. This is non-taxable, this is available to you, and then it protects and beat the inflation. So we do also, if you don't want the life insurance and you like just the steroid of the power, the growth of the money, you could use an annuity. The only thing with annuity, it doesn't have any death benefit nor living benefit. However, the growth of your money is faster. So, for example, this client, he put his money year one, 100,000, and then he left it there for the next 10 years. Then his money became 197, and after 20 years, it's 384. It's 400% the growth of his money. So that's why, where do you start from here? What we covered. So where do you start from here is, of course, you need to have a free financial analysis on how much money, because people usually confuse how much money they will put, because everybody lives on a budget. So that's why we are here to make sure that we can work on your budget. Typically, 10% of your savings or 10% of your remaining of your income without taxes yet should go to an investment and savings. Okay. So again, thank you for watching. And if you have further questions, our contact information is in the description below. So we're going to try to do it every week or every day as much as we can. We're going to do more like a case study.